I am here with a very, very fascinating individual by the name of Sean Wieland. Now, we had met on Telegram. I've been recommended some of your writing, some of your work. And I think it's going to be of keen interest to the listeners of the show because we're going off of geopolitics soon into some very advanced financial stuff. And you are a very interesting voice in that regard. And I'm going to play the midwit in this exchange because finance is something I know a little bit about, probably more than some, but not nearly as much as some of the people in our sector. So, first of all, thank you for coming and taking the time to sit down.
Yeah, thank you for having me. I appreciate it.
Now, I'm wondering, I think it's very important for to kind of establish your area of expertise just so I don't get it wrong. So, if you wouldn't mind to give a little intro spiel on your professional experience and your areas of expertise.
Sure. So, quick recap is I own an independent wealth management firm. We specialize in exit planning for businesses. Specifically, we help other M&A transaction firms on the sell side for mid-market private businesses. So that means anywhere between $2 and $100 million in sale price. That when they do sell, they're not going to have to pay taxes. We have a way of wrapping that up in a specialized kind of business trust that uses the tax code so that they get to keep all the money instead of losing about a third of it to Uncle Sam. As part of dealing in exit planning, that exposes me both to the private market side as well as then people want to know, well, what do I do with that money after it's sold? And a lot of times the advice that people are getting is to invest in stocks and bonds and publicly traded security. And that's kind of been the received wisdom basically since the end of World War II, or at least since the 70s when modern portfolio theory was invented. So that's kind of the ground that all of these other ideas have come out of.
So when again, this you're going to get a lot of very, very dumb sounding questions, and that's by design. But could you explain exit planning because there might be some confusion on what you mean by that. So this would be just a business that wants to sell, or is it exit a certain sector?
Yeah, no, please feel free to remind me if I'm getting too technical. Happy to elaborate. When somebody's selling a business, it could be to a strategic partner or strategic buyer, I should say. It could be to a private equity firm, but all of us have a lifespan. When you've built a business, at some point you're not going to be able to own it or run it yourself, and you're going to have to pass it on to somebody else. It might be your kids, it might be a competitor, it might be somebody else who has just taken an interest or been an apprentice in the business. But that transaction of how do you sell your business for what it could be worth, and then how do you know the funds that you're getting from that sale are going to be enough to live off of and live the lifestyle that you've become accustomed to from running a business throughout retirement until you pass away, and to provide for your survivors. So that whole process, it's kind of like advanced retirement planning for business owners.
Okay, so for those, a lot of our listeners are probably not in that position, but I am curious. Are there some common pitfalls or pieces of advice you'd give to people who might be interested in something like this, or might be thinking that that's their dream down the road?
So the biggest one is don't rely on the accountant that you've been using the whole time to know how to handle a transaction like this. They're usually the ones that they're worried about losing the business. They might try to even undermine it because they just want to keep you along for a few more years. It really is a specialized domain. So a lot of the experts that you might have accumulated for running your business are not necessarily going to be the best ones to help you through this transaction. So, and especially to think through these consequences of what your life is going to be like post sale. What are you going to do with your time? How much money do you need to live off of? These are things that need to be figured out before you actually go through the sale. Trying to figure it out after the fact, that it's much more, an ounce of prevention is worth a pound of cure. So it's much more difficult to correct things like huge tax obligations, or making sure you're going to get enough income from the sale of your business, or that you don't become depressed because your identity was wrapped up in your business, and without your business anymore, you suddenly realize that your life doesn't have the meaning that it had before. All these things you want to work out ahead of time as opposed to afterwards.
Now, I'm curious, in your experience, have you noticed that there's any types of businesses that are more attractive for sale, or is it? Do you work with every type of business, or are there certain ones that are more reliable in this sort of sales situation?
Um, so I haven't narrowed down to a very specific niche in that sense. Um, the ones that tend to deal with physical things tend to be better positioned for that. Real basic exit planning 101, the main issues that business owners face is dependency on the owner. So if the whole business depends on you being there, it's not exactly transferable to somebody else. Client concentration is a big one. If more than 15 or 20% of your client base is in one customer, that's usually way too risky for whoever the potential buyer is. And the third item is that your finances don't look like you've been bleeding it dry for personal reasons, or that you've been running the whole family through the business for, which is often tax advantageous. There's a reason why people do that, but that tends to diminish the valuation because it makes the business all cash starved. So that's also why it's important, ideally a couple years out, to start addressing these issues, because some of these things can take a few fiscal quarters to actually turn around and present in the best light for a potential buyer.
Now, I've got a question, and maybe this is unknowable, or maybe this is too broad of a question, but have you noticed any trends over time? And by over time, maybe I mean the past 50 to 70 years. Have you noticed an increase of businesses choosing to sell to a buyer or a conglomerate over maybe passing it down generationally?
So very succinctly, so a medium sized business, if they're going to sell, usually it's not the kids who are going to buy it. Usually they don't have the money available. That is important, honestly. Is it's better if you're going to sell your business to your kids, you need to actually sell it. There's a big problem of parents trying to hand it off to their kids, but they end up continuing to control it from behind the scenes. I'm sure there's some fans of Succession, the TV show, out there, similar sort of dynamic, and that just creates a lot of family drama. And that's a whole other area of expertise that sometimes I'll have to bring someone in just to manage those family dynamics in a family business. Um,
Award-winning family drama and award-winning
yes.
family dynamics.
um, and okay, so this actually gets into an interesting point, from like a reactionary politics perspective. Is I think basically the same way that like modernity has dissolved culture generally, you tend to hear this advice. Okay, so the buzzword in the industry is generational wealth. A lot of people want to talk about, I'd love to be in a position of having generational wealth. It's kind of a more civilized way of saying fuck you money. Um, but then there's also this criticism of that, well, everybody knows that, then your kids are going to be spoiled and they're not really going to be able to take over the company. And by the third generation, they're all trust fund kids who can't even be bothered. It becomes like Arrested Development, another award-winning show. Um, and and there's some truth to that, but I think it's also true because of the predominance of this artificial culture that's been created of, the typical talking points of atomization and deracination, that everybody's going to go out and be an individual, and you're going to go out and get this education through the university system, and then you can go off and do whatever you want. And that kind of attitude is why the family businesses are not cohesive in the way that, like, maybe Japan is kind of the counter example. There's a long history of the Japanese market almost never has these kinds of business transactions. Either it stays in the family or it dies. So we have a compare and contrast there. And yeah, I think the idea of it being sold is kind of it's a modern thing, and it's kind of an Anglo thing as well. There's an overlap with how Midwestern pioneers, whether they came from an Anglo culture or Germanic culture, approach the idea of buying and holding on to land very differently. One saw it as just this commodity or asset with a price attached to it, and for a certain, everybody has their price. At a certain price, they'd be willing to sell. And then more of the Germanic culture, who came over and said, they were massively overvaluing in the eyes of the prospective buyers the value of the land because they saw more kind of like the homestead or the haymat of the security of actually having that physical thing as opposed to just its dollar value. So the family businesses tend to work that same way, but given the culture we're in, it's pretty rare outside of like the Cargills maybe, or the Crown family, and even they turned it into General Dynamics, to really appreciate that kind of like dynastic business.
And it's true because I see many different sides to that because especially in our political milieu, you'll hear people saying like no one has these dynastic families anymore. On one hand, there is the more Anglo way, which is like it should be stress tested. Like you shouldn't just be given everything. It's good that you need to, maybe pull yourself up by your bootstraps. Maybe that's where that comes from. And I actually do
Right.
see the benefit to that.
Mm-hmm.
They don't have these sort of ossified corpse corporations being carried forward. At the same time, always throwing people in at the deep end, or the drive that I see with certain boomers, even my own family, which is like, ha ha, I'm going to spend all of my money. I'm going to sell the family farm.
Mm-hmm.
And you know what? I'm just going to jack it off right before I die, as almost, because you guys don't deserve it. So there's like both ends of the spectrum. And I'm like, yeah. And there's other, of course, inputs as well. But, maybe the idea of having a dynastic business is too foreign. We kind of, we lionize these great American industrialist families, but I think aside from like the Rockefellers or the Carnegie, like what's the modern one? You know what I mean? Like maybe like I couldn't tell you if Bill Gates has any kids who are going to take over. I assume he's going to take it to the grave.
If I remember correctly, that's why I mean, among political reasons, that's a big part of the Gates Foundation, purely from an estate planning perspective, is all of his kids have some small cushion, but I think he told them early on that, like, yeah, you're not going to get this huge inherited fortune. And, from the left or more progressive side, I mean, there's arguments where people say, there should be 100% inheritance tax, or the idea of like inherited wealth is inherently evil. I think that the desiccation of culture is really the critical variable there, that it's a lot like learning how to wield power, that if you don't hand it down carefully and in a thoughtful way that tends to benefit from a tradition, let's say, it's very easy to misuse it or to fumble it. So I think
no, but the counter narrative I've heard, because I've thinking about this time and time again, because I'm in business and worked very closely with businesses, and the conventional wisdom was always never get into business with your family, never get into business with your friends. And there's, pros and cons to doing that, but it seemed to be my entire life, the dominant narrative was the safest people to go into business with are complete strangers. And I'm like, well, that doesn't sound right either, because I've seen people get fucked over really hard simply because they've got no connection at all to the person.
Yeah. I mean, I think, again, that's kind of part and parcel of the same thing of, high trust versus low trust society. Who do you know that you can actually count on? And, the fact that we don't have these generational families so much anymore, that sense of, loyalty or what's the word? Filial piety doesn't, has basically been weeded out by a lot of institutionalization, beginning with public school. So, yeah, it also becomes, I think, the blind leading the blind, where that likely originated, and probably has more to do with, a father who didn't know how to hand it off, then getting into power dynamic conflicts with the son, trying to pass it off, and then everybody just gets frustrated and wants to walk away. And I don't know, man. There's probably an exploratory nature of that too. I think you have to figure out who you can actually do business with. That seems like a very banal answer, but
No, it's good. And it leads me to the next question. And again, this is another broad one. We're going to get to the more focused questions in a second. But based on everything we've said, can you forecast any trends? I suppose, in the sense that the exit strategy of the person building up the business, let's say throughout their entire lives, or inheriting it, then selling it. Is that a trend you see going down based on how many people are starting businesses, or starting businesses in the types of businesses that sell well, dealing in hard goods, versus all these people starting online digital businesses? Like, is this a thing that you think people will be able to do for Gen Z or Gen Alpha?
So yeah, the marketing term has become the silver tsunami. It's the demographic turnover, whether you want to call it the fourth turning or whatever. But these boomers who have built successful businesses and are now in their 70s or approaching their 80s, they do need to turn it over to somebody else. So that generational, and it's the same thing with the housing market. It's definitely going to have to go to someone. And this industry went from extremely bespoke to somewhat formalized over maybe the past 20 years. That they're realizing what their business is actually worth. That's probably the most significant asset that they own. And in order to be able to turn it over to somebody else, that's been the trend. Now, whether you raise a good point, the younger generations being able to afford it is kind of a different matter. And we see that even with the housing market. This overlaps with some other topics I'm sure we're going to get into as well, but essentially it's a liquidity crisis. Housing is something that people are a lot more familiar with, so maybe that's a more illustrative example. The younger generations got into way more student debt. They're still carrying that burden. They were completely hoodwinked by academia. We should seize the endowments immediately and put tanks in Harvard Yard in order to correct that problem. But until that happens, one consequence of that is that the millennials, and let's say the millennials are, have entered their 30s and 40s and never had a starter home. So then they've never built up the capital in order to be able to trade up to a bigger home in order to have household formation. There's, of course, all kinds of other issues with household formation and ability to find a girlfriend, get married, have kids, what have you. All of that adds up to all of these boomers who have these McMansions or large houses who are now empty nesters. And they're looking to downsize. Maybe they want to get that condo in Florida. But who are they going to sell that house to? And you see that, the younger generations don't have the liquidity and cash for a market to be made to transfer from one stranger to another. And Neil Howe, who co-wrote The Fourth Turning, and some others have pointed out that if that market can't settle, what's likely to happen is that the younger generations are going to take over as caregiver roles for the boomers, and in exchange are going to be able to buy the house. So the younger generations are going to provide free long-term care for their parents until they pass away. And in return, the kids are going to get the house as kind of remuneration for, that necessary service that would otherwise be unaffordable to most people otherwise. That certainly reinforces a sense of social immobility, that it's more of a genetic lottery of, I'm glad I was born to parents that were able to afford a big house and played their cards right when they were young, rather than having the opportunity for yourself to make that decision.
What's interesting is I think it was in Bloomberg over the past week, and I had to double check this number because it sounded astounding to me, but I had myself checked by other people who know. There's something to the tune of 75. I think it's $75 trillion worth of wealth and assets currently held by the boomers, and that I think this is what you're talking about with the Grey Tsunami. That the article was saying that there's going to be a massive transfer of wealth. Now, the question is where that transfer is, because some people hear transfer of wealth, they think, oh, that's going to the next generation, whereas that transfer could be going to cruise lines or dialysis machines or whatever the fuck it might be.
Mm-hmm.
So, and I guess that's one story where they pass it down. Does that number sound right to you? The 75, it might have been 45, but it's in the many tens of trillions of dollars.
I could look it up. That's one of those factoids. I'm sure it's probably the most significant, just kind of the inertia of history. I'm sure it's the largest turnover. Yep.
In your mind, and this again might be speculative, do you foresee a significant chunk of that being passed down to the next generation, or do you kind of just see it being spent on luxury items and goods and whatever it might be? Because I know just anecdotally many boomers in my family and friends' families who've said that they are looking forward to just splurging it all before they go, which is actually pretty easy to do if you're in a high-end care facility resort or whatever it might be.
Yeah, that part is very common. Boomers, I don't want to rag on boomers excessively, but as the most selfish generation and that kind of like, I got mine, fuck you mentality is certainly not doing them any favors. I point out it's sort of the opposite of that ancient wisdom of a society grows great when old men plant trees whose shade they shall never sit in. Instead, we have the old men, stealing the food out from the younger generation so that they're not able to start families and build up their own lives. So we have the old stealing from the young instead of the old providing for the young, which is counter to how, sustainability and persistence works. Mike Green is very good on this topic as well. He has other topics he usually talks about more, but that's a big one for him. Lending markets have almost entirely become collateralized. A lot of how boomers got their wealth was more on non-collateralized loans, even for like purchasing homes. So it ends up being a feedback cycle of, well, if you don't already have assets to back loans in order to make investments that get you more assets, if you're never able to start that cycle, you're just stuck. And it's the boomer generation that have those assets to be able to get loans to continue that cycle. And I hate to use a word like hoarding, but there is a high concentration that they're holding on to it. There is a tendency for a lot of them culturally, like you said, to want to spend it down in that way. The other issue is so much of that wealth is held in an asset bubble of these intangible securities. So primarily stocks and bonds. We can get deeper into this, but very succinctly, that's a bit of a Ponzi scheme. There's going to be a problem that as they're starting to spend that down, if markets actually settled naturally, there'd be massive devaluation as they're spending it down, the same way that there's massive overvaluation as they were buying into it. Politically, that probably will not be allowed to happen, much like mortgage-backed securities were not allowed to settle to bargain basement prices. The government stepped in and took receivership and did a controlled sell-off in order to keep prices artificially high. There's a whole factor of the role that indexing has taken over in markets over the past few decades that plays a role in that. And in one form or another, whether the government is directly as a gatekeeper, the way they did with Maiden Lane and the mortgage-backed securities, or whether they do it indirectly through groups like BlackRock, there will be some kind of gating or controlled sell-off. So lack of liquidity in order to keep prices artificially high so that boomers are able to generate the retirement income that they were promised from this social experiment of 401ks and IRAs, which began in 1974, 1975. Same time, Nixon closed the gold window, same time that the NASDAQ was started up. The first generation to really go through this. Like, we have not seen this done successfully yet. And I think that...
I want to take a sidebar there because you mentioned a lot of things. I would really like to drill down into many of them at once. But just to start, just to make this very real for people, I speak to a lot of people, especially people in my generation, millennials, who I think are secretly hoping for something akin to the Great Recession, the huge housing market collapse. They look around at all the real estate and they're thinking, when these boomers die off, all these houses are going to go on the market. I'm going to be able to do what I should have done back then. Everyone's got this sort of FOMO of I'm going to wait until everything's for $1. And I would mean some others are thinking, why would that precisely happen again? That might not be the right thing to wish for.
There's historical precedent for that, very naively in terms of market theory. That would make sense. Anyone who's seen the movie The Money Pit with Tom Hanks and what's her name from Cheers, that's exactly what that was about. Is these people had these huge mansions, then the Great Depression happened and they sat around, and then the boomers were able to buy them up for a song, but they required a lot of repair because they'd become dilapidated, as well as just a lot of other things working in their favor that they were able to buy into a low market which has since appreciated and never come back down. And especially using these assets as a store of value, there's truth that the younger generations feel like this is sort of what I was saying about what Mike Green was saying too, that they've been excluded from participating because the prices have never been low enough to really buy in to get any significant appreciation. And it's political because the boomers need to keep those prices artificially high in order to siphon off enough income for them to live off of, as they were promised. Now, whether that will actually happen is a great question. As bad as the United States is keeping the system ossified, China, I think, is also kind of the canary in the coal mine on that. It's going to happen to them, and they're worse off than it is here. So we can keep an eye on how they handle it, and that will probably be instructive as far as how the United States follows suit.
Yeah, and just let people know that's something we bring up a lot as well. Look towards China. Where America and the West is not the only one experiencing very distinct demographic pressures and falling birth rates. A lot of the phenomena that we have in the West can be echoed throughout South America, even. So, we can kind of look around and see, like you said, see the future.
And part of that too is it is because of the ossification of rules and regulations preventing markets from naturally reverting, or allowing natural price discovery to occur. More or less since 2008, we've just kind of been flying blind with any kind of real price discovery. It's completely formed by credit expansion rather than any actual productivity. China is kind of that same model too. I mean, that's the whole progressive technocratic model that I think all of modernity is following to some degree. That's kind of what the result of World War II is. And that's a topic we can come back to later for kind of the origin of publicly traded securities to begin with Liberty bonds and creating a retail bond market. But as a result, it's very much like in the Soviet Union, you had the Brezhnev stagnation. There's this period in communism where they're like, okay, I guess we can't fulfill this promise of, the automated space communism, but it's okay, and I guess we'll just settle for this and enjoy it. And that was basically Brezhnev's whole era, and it just slowly got worse and worse and worse. But it happened very gradually that people didn't really notice that everything, it stagnated. Of course, famously, Peter Thiel and Tyler Cohen and Eric Weinstein and others have kind of pointed to the West's own great stagnation. Similar sort of phenomenon. You have the academics and the managerial revolution coming in, eliminating a lot of actual capitalism, price discovery, innovation, except for some very specific fields that slip through their grasp, like information technology, which are the only places that we've actually had any real growth in the past couple decades. And as a result, there's a similar level of stagnation. So instead of a price reset, the effects are going to be, I think, a lot weirder in that if you prevented prices from correcting, what would be all of the other side effects of that, much like how underground markets or black markets in the Soviet Union, people found a way to work around it. They stole paint from the factory they worked at and then sold it on the weekend to their friends or whatever.
Which is interesting because I've heard both sides of that argument before as well, which is a lot of the more libertarian or even anarchist listeners of the show would love this sort of financial collapse scenario because, like you had said, it's more natural and they were expecting it to happen. On the other hand, I've heard maybe more central planning fans happy that things are artificially stabilized. And I suppose this will sound like, again, midwit question. Which would you prefer? Which do you think would be better for America if the prices were just allowed to naturally fall, or the system we have now?
I think, it's kind of like the guy who's overweight or the guy that has to work out at the gym. It's like, which way do you want to suffer? I think the price has to be paid one way or the other. I would prefer to see some actual price discovery emerge. There's a part of me that also, unfortunately, I'm not king of the world, that I get to decide this. It's more, from my perspective, I'm trying to figure out how to hedge my options to navigate whichever way it does go, rather than thinking about what my idealized state is, because I'm never going to be in a position to impose my idealized state.
Well, that's a great answer, and I'm wondering if there's, with that in mind, what would you recommend? The young listener or the young man who is in the situation. Maybe he doesn't have any sorts of assets, any sort of financial stability. What would you recommend they do to kind of insulate themselves or prepare for things the way you would?
Okay, so
And maybe I'm getting ahead of myself because there are a few things we could get into about the securities markets, about these other things, and maybe that
no,
leads into it.
so it's a fair question. I'm just trying to think how to tackle it. On the one hand, since I'm entrepreneurial by nature, it's very easy for me to say, well, you should start a business, and there's this gig economy or hustle economy, and that's how you're going to have to learn how to survive. There's also the part of me that knows that that's less than 20% of the population, right? The bottom 80% are the NPCs who are never going to do that, and I think they're often misled by the Gary V's out there that everybody can be this great business success, and
Everyone needs to quit their job right now.
right, and they're just not cut out for it, and selling that to them is also disingenuous or abusive as well. So
It always seems to be two tracks. It's either quit your job, follow your dreams, and anything else is slavery, or you need to start credit maxing. You need 25 credit cards. You need to be borrowing money for no reason. Just do it. Get maximize free stuff. Those are the two that I hear the most.
And that's fair. I think the follow your dreams advice is probably the worst of those two. It is helpful if you are passionate about whatever is going to make you money, because it's a lot of work. You're grinding all day, every day. And unless you actually are interested in that thing, it's very hard to find the motivation to do that long term.
And I'd like to just underline that for people, because I've had a few individuals come to me, and I've dealt with people like this who think like, oh, I see these people, they make lots of money on this stupid business. It's dumb.
Mm-hmm.
I should start a dumb business. I'm like, don't underestimate how difficult it is to run a dumb business. No business is easy, because whatever it is, you're doing it 15 hours a day. So that's kind of where the passion comes in, because I'm like, you need to pick something where you're not going to blow your fucking brains out doing it. And if you're doing it where you're putting pug faces on mugs, you might blow your brains out after a week, even though it's okay financially.
And then there's the part of me that I just, because we've been divorced from real price discovery for so long, that one of my portfolio partners, Jason Buck, if he's listening to this is also maybe part of the answer too, but he kind of has this postmodernist, we're all just entertaining each other perspective. And it's only when people have not known real scarcity for so long that anybody can have that outlook. And there is kind of this, period of decadence. I should probably finish reading The Ancient City one of these days, but that flowering era of a civilization that happens right before senescence. And so a lot of this economic activity of why people become super rich and famous for seemingly no productive activity whatsoever is also baffling to navigate and difficult to deal with. So that's also part of the entrepreneurial question, is people make money off of the dumbest things as well.
Yeah, there's a few individuals I had known who take a very strong anti-ideological but pro-financial approach, to the point where they're like, the best way to sort rank someone's genetic value is how much wealth they have, how much money they have. And if you're poor, you're dysgenic. And I'm like, okay, but then you have to explain OnlyFans whores with mansions. Like,
Right.
There's a lot of examples
Exactly.
of rich fools, right?
And I think that's a consequence of that. This century of modernity, the easy targets are central banking and income tax. Thank you, Woodrow Wilson. But yeah, I mean, maybe this is a good segue to get into the third pillar that people are missing is the rise of publicly traded securities and publicly traded stocks. So the bond market is what underpins that. That's completely generated to provide the government with resources. It's a completely fugazi market. And then all of the rest of Wall Street is built on top of that. So it's a simulated system. It is not tied to any kind of actual reality. It's this artificial bubble creation. So yeah, I would not put too much faith in. You know, it's garbage in, garbage out. So
And what's interesting is for people who track the market, and we've covered a few financial books on the show before. I think one that I found most interesting was we did the history of the stock market, but we also did Mandelbrot's The Misbehavior of Markets. And what's interesting is a lot of the, and again, I might be telling you stuff you already know, or correct me if I'm wrong, but a lot of financial planners will treat the stock market as if it is this self-contained entity, and just look for, you can look at the news, you can look at everything, but there's so many inputs. It's almost like you can just watch the market and find trends within trends, and as if it's this free floating entity divorced from reality.
and in that sense, they're not wrong. And that's what needs to that's what has to be managed, is kind of you're not going to be able to predict that. Now the issue there is the way most, if not nearly all, financial planning is done. Markowitz actually just recently passed away. He invented kind of or at least most of the groundwork of modern portfolio theory. And my own opinion on that is basically it's a marketing paradigm. Even he himself did not use it. He just put 50% in bonds. 50. He said 50-50. I'm flipping a coin here.
If you could, we would have
go
discussed
ahead.
this many episodes ago, but modern portfolio theory, would there be a way to summarize that very briefly?
So the people who invented it never traded a share of stock in their life. They're basically mid-20s college kids looking to write an academic paper, and they made a bunch of back-of-the-envelope assumptions of assuming certain idealizations of the market. Could they then predict or model the risk return of investments? This is where all the quants come from, or factor investing. It kind of has a lot of overlap with the historical school in economics. I think a lot of times they're chasing ghosts, or they're chasing their own reflections with this stuff. It's where you get the idea of 60-40 portfolios and the efficient frontier. The problem is all of these assumptions that go into it, and many of them are unfounded, or many of them are based on things that appeared to be self-evident truths just after the Bretton Woods post-World War II economy, that are not necessarily universal or eternal truths. And as those assumptions break down, again, it's one of those garbage in, garbage out scenarios. So things like bonds should be safe and stocks are risky, and there's certainly a lot of truth to that, or at least that the stocks are risky part. Before, in the pre-war era, and arguably even now, stocks are a speculative investment. And it wasn't really until computerization and marketing in the adoption of modern portfolio theory in the 1970s allowed all of these financial firms to go out and be financial advisors to families and say, look, no, we've got this scientifically figured out. These are the numbers. And yet simple things like, well, we don't really know how to measure risk, so we're just going to look at price variance and assume that volatility in price is going to be a good measure for risk. But volatility to the up end is good, though, right? If your stock shoots way up, you must be doing something right. But it doesn't take that into account. It's really poor proxy for risk. And especially then, as we went into a declining interest rate environment, obviously that's changed somewhat recently, but when bonds had very low yield rates, people were trading them speculatively, expecting the next rate cut to come through. And even now that they've shot up, people are still trading in this fashion of, well, I'm going to buy bonds expecting the value to go up as soon as there's a rate cut, which is the same speculative nature in which people used to buy stocks, as far as, well, I'm assuming a company is going to be more profitable in the future than in the past. So if you're trading both bonds and stocks in the same way, and if you're not getting that steady income yield from bonds, but you're just worried about capital appreciation, well, now the trading behavior and the price signals of the stocks and bonds are going to be in sync. And stocks and bonds are correlated. I think it's like 86% correlated. Don't quote me on that, but it's very significantly, which means you're not getting any real diversification at all. This is where anybody wants to do some additional research on this, or I could probably get him on the podcast, Jason Buck over at Mutiny Fund with his cockroach manifesto, cockroach portfolio, has really done a lot of great work on this. That, you know, all of that are offensive assets. People think they have this diversification. That's a complete illusion. And every time there's some kind of systemic crash, like a 2008, stocks and all assets correlate in down markets, which means you're not getting any kind of protection at all from that. Daniel Parise is also excellent on this. Book I'd add to your reading list if you haven't read it already is Getting Back to Business by Daniel Parise. He completely demolishes modern portfolio theory, that it's I mean, this might be strong, but it's quackery. It's a way to present an illusion of rational, predictable markets where they don't exist.
Would there be any advocates of modern portfolio theory that you can think of to give people? Because as I'm hearing this, I'm hearing pangs of, you know, the movies where I've heard this brought up, or this is kind of a dogma in a lot of the financial
Right.
movies and
Mm-hmm.
stuff. So would there be any individuals that you can point out, like these are the guys who are really into portfolio theory?
I'll go so far as
because also this would be something that when people talk like, oh, in the future they're just going to have artificial intelligence to rank stocks and stuff like that, it seems like this would be the maximization of this sort of thing, like just looking at the numbers and how they behave.
So that's a great point. Corey Hoffstein over at Newfound Research is great. He's kind of the only quant that I actually respect, because I think he does have this capacity for self-criticism, and yet quant analysis is still, and he also likes to think through these thought experiments as well. So it kind of keeps him grounded. And so it's interesting that you bring up AI, and I mentioned indexing before. Mike Green has an excellent criticism on indexing and this illusion of so-called passive investing. Indexing is really just algorithmic investing. There's no such thing as passive investing. And that modern portfolio theory kind of set the table, and then indexing is this logical extreme conclusion of that mentality, this idea that markets can just be calculated, which when you get to that point, you kind of realize, well, that can't be. That makes no sense. This idea that it's just entirely predictive, that means that there is no actual price discovery. Like, why are you having a market at all if it's all just, predetermined? And I think that's kind of what's going to happen is big indexing has passed the 50% mark in markets because most benchmarks, even for active fund managers, are based on an index. They become closet indexers because they're worried about their professional risk. This is going to start to get into the principal agent problem, which is a recurring theme in what I do as well.
Let me just ask you a question. So again, this is probably going to pull the emergency brake, but when you say indexing, can you summarize what you mean by that? Like someone is indexing.
So, John Bogle popularized indexing. The idea, so like the S&P 500, you often hear this generic received wisdom of, well, you can't beat the market. You're just going to buy and hold. It's the cliches of it's time in the market, not timing the market. So I'm going to buy some ETF or index fund that is supposed to represent, the top 500 by weighted market cap.
Okay, this is what I was going to ask, because I read a book a while ago that I believe was advocating just for this. It was called The Millionaire Teacher. And the entire book is like 200 or so pages, and the entire summary of the book was invest in index funds. And if you invest in index funds in your 20s, by the time whatever age is, you're a millionaire, because the market, literally the entire book was, well, the market always goes up, so just invest in the market.
So that should be the warning right there. That in a more cosmic sense, the market is very new. There's kind of this dubious history of, market, publicly traded companies or shares of stock go back to the Dutch East India Company in the 1600s or whatever. That's all kind of BS. It's a way of trying to extend the timeline to make it seem like this has been around for a lot longer than it is.
Yeah. Anytime, whenever I read the books, I think we might have done this. We read this book, Devil Take the Hindmost.
Oh yes, yeah, that's excellent.
Yeah, it's a good book, but then you talk to some people, it's like, in a sense, the stock market goes back. It starts in the year 12. And I'm like, okay, well, you might be trying to validate some modern ideas by saying, this thing that we're doing, the knights used to do it too. I'm like, I guess, but not really.
So okay, so now we're starting to zero in on where my forthcoming book starts to touch on, and where my interests are really with this is yeah, sure, markets and even commodities markets, or hedging risk in that sense, or pooling investment, is probably a timeless activity. This phenomenon of let's say corporate shares, or these publicly traded markets, especially in concert with central banking and income tax, and kind of this managerialist approach, is relatively new. It emerged at the same time as those other things. Again, Liberty bonds, as far as I can tell, are the origin of it. The legislation that created Liberty bonds, originally just to fund America's entry into fighting the First World War, set the stage for all government debt. I mean, we just went through another debt ceiling crisis that came out of those laws. There have been defaults before. Before that, there was a civil war as well. But the Liberty bonds really also created the beginning of the retail market. And then it's frankly not surprising that very shortly after, then, in the 1920s, that's when you have this Wall Street boom culminating in, was it Black Friday in 1929, and this giant crash. And also, to address your point of stock market only goes up, except for, I'd have to pull up the chart, but it's maybe 3 or 4 periods where it has either been in decline or flat point to point for between 5 to 25 years. And the Great Depression is the big example of 25 years. So modern portfolio theory also tends to assume, in that same way of, like, suppose a spherical cow of uniform density, that people have these infinite hold periods, which is just, there's no way you're going to hold on to a security for 25 years waiting for it to finally bounce back. Or if you are, you probably never even needed that money to begin with. This idea that people are going to have to sell at some point in between at a loss, I think is just unrealistic to the fundamentals of the human behavior involved.
It's funny you say that, because as you were explaining it, it did occur to me that, like, yeah, I never hear people holding on to money as if they need the money. Like, you assume you're just going to, because that is the wisdom that you would receive from these index people, which is like, yeah, it might go down for 25 years, but you're going to be holding it until you're 80. I'm like, well, life doesn't really work that way.
Right. You're constrained to your, God willing, 80 or so years of life, right? At some point, and like the boomers are facing now in a demographic crisis, at some point you're going to have to sell. There's going to have to be a counterparty. Indexing also tends to give people this psychological illusion of, like, it's a redemption. This index fund or ETF is worth such and such amount. I say sell, and then it just magically turns into money. And they ignore that, well, for every seller, there must be a buyer. There has to be somebody else on the other end of that trade willing to accept picking up what you're trying to get rid of. And we're back to that point of the younger generations really were emotionally scarred from the 2008 crash. A lot of them really think that the stock market is, the casino, or something that's not worth participating in. I know the counter criticism to this is, well, there's just so much institutional money there that they'll always find a way to absorb it. And yeah, coming back to whether BlackRock or these other companies are going to be able to extend these artificial markets, or otherwise facilitate a organized sell-off in order to maintain artificially high prices, that could be.
Well, it's interesting that you mentioned BlackRock, because I know we've talked about them on the show before as well, and I know that BlackRock, their prime, I think over 50% of their assets are just in retirement funds or something to that effect.
Mm-hmm.
And I was wondering, actually, I'll say 2 things. One, just to your last point, this is something I've noticed from boomers as well. And just to say this, we're not anti-boomer on the show. I don't like participating in this intra-generational warfare,
right? Yeah, I'm with
that we see on our side. But I have they're a product of their time. They're a product of a very unique historical period.
Yes.
All of us would be boomers if we were boomers. That's how I
Hmm.
look at it.
Yep.
But at the same time, the way I hear them talk about their retirement funds, it does not rise above the complexity of I paid into it, so I get money now. It's just money. It's free. But there's no understanding of the mechanisms of where that money goes, where it comes from, how it balances out. They just think they paid in, so they get free money now. And I think that's an interesting way. That's something that the younger generations are not afforded. They're maybe even extra paranoid about how the money floats around up there. But just leading into the next point, BlackRock, their heavy investment in retirement funds. What role do you see BlackRock in all of this? Just because people will hear that name, and BlackRock has a lot of dirt on its name right now, but how do you see this shaking out with BlackRock involved?
Yeah. So I think they're dirty, but also sometimes they're not this exaggerated supervillain, or they're it's the banality of evil, I think, for them. Jim Rickards in one of his books gets into, I'm pretty sure, I'd have to fact check this, but I'm pretty sure they're a primary dealer, or at least associated with a primary dealer. They're in bed with this state financialization system. The question is, are they going to be the mechanism by which liquidity and markets are managed in order to keep those notional values artificially high? So again, to frame it, the 401ks and IRAs, none of that existed before ERISA was passed in, I believe, 1975. And that was basically a license to print money to the mutual fund industry and to Wall Street in general. It was right on the backs of closing the gold window. It's whether intentionally or unintentionally, it was a great way to absorb the inflation, which was a very pressing issue of stagflation in the 1970s. And what you're basically doing is telling boomers at the time who had just entered the workforce or had entered and finally started to really build their careers, delay taking this income from your paycheck now, save it for later. This is what all the smart people are doing. You're going to delay gratification, which is what smart people do. And then trust us, when you go to retire 40 years from now, it's going to grow. And because the market the market goes up, maybe there's volatility, but in the long run, it goes up. You're going to be able to withdraw it for more than what it's worth. And you're going to stay ahead of inflation. And that staying ahead of inflation piece was also, that's the origin of it just after the First World War. It's when persistent inflation really started to kick in. It used to be, you just put your money in the bank, you're going to get a 4% interest rate, and you're going to benefit from deflation in market prices due to increased efficiency of capital structure for maybe another 3 or 4% on top of that. So when you go to take the money out to buy something, it's going to be cheaper and you're going to get more for your money. And the introduction of inflation completely turns it around. And the reality is that most people are savers, not investors. So exactly to your point, all these people are participating in a system that they don't understand. I doubt, maybe formally, but informally, I sincerely doubt most companies satisfy what's called their 404C requirement of 401ks, which is that their employees understand what they're doing when they're making investments, of the investment selection inside of a 401k. Most investment selection inside of 401ks are complete garbage. There are ways to get access to brokerage now. But then again, most people don't know what they're doing. And even the market that's available through that, it's predominantly stocks and bonds. And those are all offensive assets. You're really not getting any defense or hedging from it. They're all long on the economy. They're all assuming that the economy is going to continue to grow and do well. And they don't really do anything for you if the economy starts to contract in order to protect your savings and purchasing power. And they're the first generation to go through this social experiment. The pensions were mostly killed off. And it remains to be seen that as they're making withdrawals, is there the market liquidity there for somebody to be on the other side of the trade to actually buy what they're selling? They get like the housing analogy I made before. Even if that's there,
well, I was going to ask you. So, a point you had made that I found so fascinating was that this entire thing you're talking about was a way for what you call the managerial class to get its own financing and sort of seize the means of production as a softer form of communism. I think that was the line you had said. I found that so fascinating. So, is what we're
Yeah. So
talking?
and
Yeah.
so this is the way that it's achieved. So that's I like to think of it as the three legs of the stool. So most people are very familiar with the arguments against central banking and income tax, but then when it comes to publicly traded stock, people act like, oh, this is the height of hypercapitalism, and it was invented by basically the managerial class who knew they couldn't directly seize the means of production like in a communist revolution, but they could do it through financialization, which was something that they controlled. And there's that famous quote supposedly by Lenin of that central banking is 80% of communization or something like that. And where that gives power to, okay, let me think of this. So where that gives a power to the managers is, they're going to be compensated in corporate stock. They're going to be in a position as managers to give themselves those golden parachutes. And as a result of, and then what was it, in the 80s, they got rid of the rules against stock buybacks. Basically, it's a financialization where they no longer have to worry about being profitable. What they need are the access to the lines of credit and financialization in order to get the share price or their notional value of their stock to go up, which is how they get compensated and all that anybody pays attention to. And so the owners are asleep at the wheel. As you said, well, as long as stock price goes up, they don't care. They assume something must be working if stock price goes up, but they're not looking under the hood of, well, this company isn't actually profitable anymore. It's zombie capital. But because the share price goes up and they assume those markets are always going to be liquid, that they're gonna get the value of the stock as it's written on their statements, and that system can be perpetuated to never correct or crash. That remains to be seen. Kind of circling back to us in China, whether that artificial bubble system can be maintained, and it makes it very difficult for capital that is focused on making a profit to compete with the free money of politically aligned banking credit.
And would that be the ESG stuff we hear about? Because that sounds like I don't want to just put words in your mouth.
No, my critique on that is, that tends to be the boomer tier take, because it's looking at a very narrow piece of a larger phenomenon. ESG is certainly part of it. They're also just covering their tracks for the fact that these companies aren't profitable, so it's misdirection.
That's interesting because we had our own talk about ESG, because it's very much, BlackRock's a boogeyman, of course, and it's also kind of a spooky name. But we did a whole episode looking at ESG not only as a phenomenon that any other day many people on what we call the distant right would like they might, do you hate the mechanism, or do you hate who's controlling the mechanism? Do you actually hate this thing called stakeholder capitalism? On the other hand, it also seems that Larry Fink is set up as the spokesman of it, interestingly, which almost seems to me like they're hedging their bets, where if they ever had to turn it around, they could say, well, that was Larry Fink's thing. But on the other hand, I'm like, in a lot of ways, they're just reacting. Like when Larry Fink goes out there and says, we're just reacting to the European energy markets. They didn't invent the drive for green energy. They didn't invent the E and ESG. They're just reacting to the markets. So how much of this is a nefarious scheme, or how much of it is reactive? And I liked what you had said there, which is it might be used to cover up that these other companies are not profitable. Would you mind going into that for a
Sure.
little bit?
So much like like how the 2010s Great Awakening was very jarring. You get a whole new batch of ex-leftists who become conservatives, the intellectual dark web, and James Lindsay and those types, and complaining about ESG or central bank digital currencies, the CBDCs, are just kind of these little slices that they're worth criticizing, but they're part of a larger phenomenon. And this idea of, we just have to get rid of those and, go back to the 1990s when everything made sense. It's a similar part of that delusion. I mean, we have to go back to the 1890s to actually get anything like a real natural productive capitalist market. So to selectively try to go after ESG or CBDCs, it's going to be a game of whack-a-mole. Even if these get stopped, there's going to be whatever the next thing is. And I would even include things like indexing and ETFs and other tricks that have been set up that that are kind of perpetuating this system that is divorced from any kind of real measurement of like material prosperity.
Okay. And I suppose I just have to return back to the question, what would be a survival strategy for the average person within the system? We talked about, owning your own business and whatnot. Is there any financial model? If we're not going to go back to the 1890s, what would you recommend the young person who has no assets or anything? How should they operate within this system?
So yeah, so that's a great question. I don't know if I have all the answers for that. Most of my clientele, we're talking about people who are accredited investors, right? So a lot of my thinking as far as solutions is geared towards someone who's built a business, it's grown to be worth, say, $10 million, and then they want to sell it off to somebody else who is going
And
to
I
be
guess we could to start like with the first thing, would we recommend that people start their own business rather than get into just employment? Like, would starting a business be something that maybe groups of people should be doing now if they can?
I would say it would be along those lines. Jason Buck, who I mentioned earlier, has this great line of people need to get out of this boomer mentality of the stock market being a place where people get rich. Even if you're a super sophisticated investor in the way that he's set up with his fund, and you're sitting on $10 million, yes, there are other asset classes and other defensive diversification strategies that will help you weather this scenario and generate an income that you can live off of, and you can live like landed gentry. But if you have not built up that capital first, you're not going to do it by investing in an index fund. Yeah, you're going to have to figure out your own way to amass wealth first, and then think about the defense.
Yeah, and so there's a lot of young people, and I think they get bewitched by crypto as well. Like people looking for the payday, thinking that if they can game the system, that's where the smart people go. They can game a system to make money easy. And it sounds like you would recommend going the opposite direction. Like you want to build up wealth in a more tangible way. Would that make sense?
Um, Generally, yes, I would not bet the farm on crypto. But I'm very empathetic to, going back to it's a generation that was never able to buy in at the beginning. Everything was already overbought by the time they showed up on the scene. And crypto was the one exception to that. So it's no wonder they saw like, oh, it's a new asset class that I can get in on the ground floor and participate in the ride up, just like the boomers were with housing and the S&P 500. So I understand where they're coming from with that. But at the same time, yeah, that does rest on this larger phenomenon of asset bubbles, which is what's facilitated by this managerialist centralized economy from central banking and credit expansion. Very similar to junk bond market being invented in the 80s due to inflation and high interest rates. This is what tends to happen in constrained situations like this. Is people are looking for a new source of capital in order to provide fuel for whatever their investments are. And when they can't get it traditionally, they try to create some new thing to fill the gap. And I mean, that gets in a whole conversation of how credit expansion also happens peer to peer as well. Every time somebody says when they do a net 30 running a business that they have accounts receivable, that's also a form of credit expansion. So there is always going to be that to some degree. But yeah, I would not count on a growing asset bubble to survive and thrive.
Yeah, that brings us to one point that you had talked about, and this is something we've been building to this entire talk, which is that you said the publicly traded markets are in a bubble currently, but you had said that private markets are likely a better opportunity as the boomers retire and die. And I was wondering if you would like to expand on that, as perhaps the difference between a public and what you mean by a private market and why that would be the case.
So publicly traded markets are the ones that people are probably most familiar with because we lived through a lot of IPOs in the 1990s through now. It's what the financial news cycle is really oriented around. Publicly traded companies tend to be the powerhouses in the economy. it's regulated, and it's so that is generally kind of this
And people tend to see them as safe investments as well. If something is publicly traded, that legitimizes it in a
and
sense.
yeah, and that's this whole I'm looking for the words, artificial system of modernity. It's really no different than
It's like
this.
corporate credentialism in a sense, I guess. It's just it's not real.
Yeah, it's as real as the communists in Russia saying, okay, well, we're going to have this planned economy, and we're going to know what our production quotas are and what the consumption rate is, and we're going to figure that they're creating this illusion of safety and scientific planning, and hey, we really know what we're doing because we're the experts. And because it's divorced from any kind of discipline of feedback in price. If you're trying to sail across the ocean and your compass didn't work, and it was cloudy and you couldn't see the stars, I guess, you're like, well, let's just keep sailing, and the direction doesn't matter. Well, you could be sailing in a circle and go nowhere. And I think this whole publicly traded capital system has become that. The managers who have taken over these things as a matter of career like it. They know that's how they get paid. That's how academicians end up filling these MBA roles. So they like it because it's a way of confusing, the tracking money for real production and consumption of resources with kind of this artificial. It's like an accounting fiction, and by blurring those lines. So there's something called M&M theory. It's named after two people. Names begin with M. Also, the weighted average cost of capital kind of gets into this as well. But there's this idea of like how much debt load a company should take on or how much credit they should utilize in order to be profitable. And what ends up happening is basically credit, or was it like Say's law, right? Cheap credit crowds out good real money. And so, these careers are going to go to where the money is. And that's now this artificial asset bubble that is divorced from any kind of genuine productivity. And if that price is not allowed to correct, and the whole reason it got distorted that way to begin with is because of the system that's already in place and is controlled by, the most politically influential people in society, if they can help it, they're not going to let that system collapse anytime soon. So there's no corrective measure. Instead, much like the fall of communism in the Soviet Union, you're just going to get this ossification of things aren't resolving. Instead of being forced to actually fix a dysfunctional system, the dysfunctional system will just ride out until collapse. So,
and I had one question, and this might be a little late in the game, but when many people hear the managerial class, they might have read the Managerial Revolution, and they'll be familiar with the managerial class as government officials. In this instance, would the managerial class be a different group of people, or how would you define them?
So I would argue a bit. So a big inspiration is Carol Roth. Just during or after the lockdowns that we went through, wrote "The War on Small Business," and this is where you can see a very stark, political class divide between the publicly traded mega companies and then the small businesses that wanted to stay in business. The big publicly traded companies don't want to compete with the small businesses. They don't take marching orders. The same people who are trained to go work in government agencies, the same people who are trained to go work in the C-suite or management of these publicly traded companies, and it's a revolving door back and forth. I mean, I think even generally liberal people will talk about the revolving door between working in the pharma industry and then working at the FDA and then going back to work in the pharma industry, or working in the military and then working for a military contractor and then back in the military, or what have you. So this is all the same pool of people, regardless. If I ever get this one book out of me, the one I'd love to follow up on after that is I think if we actually took a full accounting of the American economy in general, it'd be more than 50% state controlled. When you start to add up Unicor, which is the prison slave labor system, and that everything that is made like furniture and flak jackets and battle helmets and stuff for the military, there's laws that has to be made by prisoners. So we're not doing any better than the Chinese, where they're getting the Uyghurs to make their solar cells. When you look at how government contracting works for like how Humvees were invented and manufactured, the public-private partnership, or like public choice theory, just that interweaving between regulators and the commanding heights of the private industry. At some level or another, very little of it, less than half, I would go on a wager, is actually determined by anything like market forces. I think we have far more command and control over the economy than we realize. It's just a lot more like Curtis Yarvin's piece on the two-stroke regime versus the four-stroke regime. There's just a little more elaboration on our part. Instead of it being pure, very obvious dictatorial communism, we go through these extra steps to create the illusion of a market and an illusion of democracy, so that everybody goes along with it and thinks it's, oh, well, the market decided that, which is what you heard with, censorship on big tech platforms. Oh, well, big businesses can do whatever they want until Elon buys Twitter, and then it's fascism.
Yeah, it's very interesting you say that. And the way you describe it, I think, is attractive to a lot of people because it seems to cut across ideological divides that you'll hear. I can imagine nearly every political persuasion complaining about the framework that the scaffolding of this system that we've just identified. No one's happy with the way this is.
Yeah. So that goes back to the iron law of oligarchy, or selectorate theory, which is kind of the reinvention of the very same idea. When that the system is complete when when congressional persistence is at an all-time high and congressional approval is at an all-time low. That everybody hates Congress, but nobody can vote them out. That's kind of an interest. Okay, so the system's been captured, and across the administrative state, and then how that's done through publicly traded companies, which are all owned and controlled by the same people or who share the same mentality about how things should work. So it doesn't have to be an overt conspiracy. It's just a distributed conspiracy of people who think the same way. And that's the divide and conquer too. You'll get let's say in a very historic sense, maybe you get conservatives or Republicans saying government is the problem, and you get Democrats or progressives saying big business is the problem. Well, government and big business are the same people. So who are we? The fact that we're pointing fingers at each other doesn't solve anything. We're talking about the same group that is the successful oligarchy in power.
And also, it's the ability to defend the status quo, which is something that we've been discussing more and more in our investigation into geopolitics. And then once you explain that the status quo it does not mean the ideal, it just means maintaining whatever it is. And if you find a system is very, very good at protecting whatever the status quo is, or any actual change is displayed as threatening the status quo, that means that is a very, very powerful system that's not designed for change at all.
Right. It's like Uncle Ted's system's greatest trick, or whatever he called it. Any kind of criticism ends up being absorbed into the system itself to nullify it. And I think that's been the resiliency of this modernist regime, where prices don't matter, and they've tried to contain volatility in order to keep their jobs, right? All these people are not so another topic that I don't know if we have time to get into, but I'm happy to if you want, is that all of this in modernity gets down to high time preference, short time horizon, whether it's voting, managerial decision making, the fact that none of these things ever really get fixed, even though everybody complains about it. It's an entire system that's just geared to only being able to deal with things short term. Nobody has the power or the authority like a private owner does to take on large projects. So the high time preference, that's kind of the whole modernity project. It's the desire to be liberated from the discipline of scarcity. So whether that's through democracy or communism or this managerialism, it's that, I want to be able to accomplish these great things, and I don't want to have to worry about how I'm going to pay for it. So that's kind of now I'm trying to think before the break where I was gonna go with that, but that ends up being what's incentivized. So like for a manager, for example, while you always hear about the people raiding the corporate pension, or that woman who tried to do the woke marketing campaign for Bud Light and completely tanked it. And people are like, oh, I can't believe this would happen. Or even going back to, we're talking about BlackRock before as kind of a boogeyman. And another one of these boomer talking points that tends to come up is, oh, well, it's because they're the shareholders, because they own it, they're in control. And if BlackRock buys everything, then they're going to own us. The managers are the ones who actually have the control. The whole reason for this does go back to Daniel Paris, in addition to demolishing modern portfolio theory. He has a really great thesis on stocks used to have to pay a dividend in order to prove that they were worth holding on to. And then that completely evaporated, and now people are just worried about increasing share price. And actually part of modern portfolio theory is this idea that dividends and capital appreciation are fungible, which is not true. There's a major liquidity difference there, if nothing else. That they want to run these organizations and get paid and live a nice life, very much like the nomenclature, to be a factory manager in the Soviet Union, running a business knowing, okay, well, I'm getting paid in shares and the share price is going to go up and I'm going to make this money. But they're divorced from the reality of whether their company is actually successful in any kind of like profitable market demand way. Which is why, in our circles, you often hear the criticism that get woke, go broke doesn't really happen. They may face a setback or two, but they eventually stabilize. And it's through share buybacks and financialization and being able to issue bonds and credit that these companies can do through public markets that, they really don't need to be profitable. They just need the illusion of profits to sustain this system. But it's a closed loop. They're completely divorced from what they do actually being useful, as far as whether those people keep their jobs. And they're happy to let these companies crash and burn as long as they get their golden parachutes, which is also kind of a left-wing or progressive talking point. Is they're happy to screw these companies over and let them fail as long as they get to leave with their money. So it does boil down to that principal agent problem, just like you'll see in politicians. Politicians are going to sell their office in order to enrich themselves. And managers at publicly traded companies are doing exactly the same thing.
Okay. And do you see this? Do you see an end point of this at all with the I guess this distinct managerial class having no regard for profitability? Like, is there a terminus to this where it does collapse, or does this just happen indefinitely? Where the whole go woke go broke thing not mattering, does it ever start to matter?
That great watchword of like eventually. It took 70 years for full total communism in the Soviet Union to fail. That's somebody's lifetime. That's several people's lifetimes probably there. This softer version of it could, what's that Keynes line of, markets can remain irrational longer than you can remain solvent. So I think that's kind of the difficulty there, is if it's this very slow collapse, it may not even happen in our lifetime. I'm sure in ancient Rome, people saw the same things as well. Rome wasn't built in a day, and Rome didn't collapse in a day. It was a very long process until one day it just went, right? How'd you go bankrupt? Well, at first slowly and then suddenly.
I wonder, there's a lot of debate in our sphere about, for example, ESG and the woke agenda being purported by these organizations like BlackRock. Do you see that as just sort of do they believe this? Are they ideologically possessed, or are they reactive, or is this something they might just abandon one day, or is it part of the plan? Or how do you think this all fits together?
So all of the above. I think so like the rule zero is whatever lets them keep their job and position of authority and getting money out of this. So they'll do whatever, helps their career advancement. Again, that principal agent problem, I think, is probably the most paramount. Beyond that, that distributed conspiracy concept, or, they all go through the cathedral of, they're told this is what smart, good people think, and this is what they believe, and this is what they should be working towards. some of them
So in
might.
a sense, they're not advocates. They're not the soldiers. They are the subjects, similar to anyone else who goes through the schools, in a sense.
I mean, I think this is the reality in which they're presented. And because it's an effective patronage system, this is what provides them with real material benefits. I mean, there's a reason why. Okay, so a compare and contrast is in the 1980s, how many members of the Communist Party really believed in communism itself? And how many of them are like, well, this is just what you do in order to get a career so my family doesn't have to eat shit. Like this is just the process that we're in now. I'm sure some are true believers and some are completely cynical, and most of them are probably somewhere in the middle, or I'm sure they're not sending their best. There's the whole bio-Leninist phenomenon that probably very few of them are even that self-reflective on the whole. Like they're not even questioning the nature of their reality. So I think a lot of that is just that's the world that they're presented. But the overall, if there is one unifying theme, it always seems to come back to, I don't want to have to deal with scarcity. I don't want to have to compete for resources, and so I'm going to figure out some story, some narrative, some Sam Francis in one of his books, I have to remember which. I think PQ read it at one point as well. Talks about there's the talkers and the doers. That doctors used to be a doer profession, and a lot of blue collar work is a doer. Like if you build an airplane, either it flies or it crashes. It's very obvious whether you're doing your aeronautical engineering job correctly or not. But no offense to fellow marketers out there, but marketing or politics are a lot of bullshit jobs. There's always some spin control of, Indiana Jones 5 didn't do well in the box office. So that's because, the fans are racists, or there's always some excuse and some spin and some reason why you can talk yourself out of getting in trouble and having the feedback of getting fired or not making money or whatever, or we'll just do another project to cover it up or whatever. So I think that tends to be it's the bio-Leninist argument is, those who can't do teach. The ones who are not suitable or capable of doing the things that actually materially make life better are then attracted to jobs where they can just BS their way through it. And I think that's all of academia and managerialism. That's why they're drawn to those jobs, is because they fail upwards.
Now, this might be, again, another speculative question, but it seems that with advanced industrialization and with AI and with all the stuff people talk about, there might be fewer and fewer of those practical jobs, those doer jobs, and a maximization of the talker jobs. And then that middle area, it seems that that's the only place that the people, the jobs being outsourced, there just aren't those jobs anymore. So it seems like those bullshit jobs would be the only jobs left. And this is something we joked about because I'm in Canada and I lived in Toronto for a while, and this is a massive urban center, one of the biggest cities in North America, and it seems that everyone there just works either as a server or in some skyscraper or in an agency of some kind.
Mm-hmm.
And it's all people do is send emails to each other.
Right.
And
Yeah.
it's very, very difficult. If you ask these people to explain their job, most people can't do it. And that seems to be that is a shared story, I think, across many urban centers. And I do wonder in the future, is this sort of managerial class the only type of career that will even exist? And maybe that's dystopian, but I don't know. I just wanted to.
So there is even a guy who wrote a book called Bullshit Jobs, and I'm pretty sure he's like a shitlib otherwise, but he's made that same observation. And I certainly kind of assume that's what I'm sure that's what they're telling themselves. I'm sure that's what, when you go to a Davos conference, that everybody's worried, AI is going to take over and we're all just going to have these intellectual jobs. And I think even from the beginning, as academia at the turn of the beginning of the 20th century did not like these personal kingdoms of the Rockefellers and the Carnegies. So they said, no, as academicians, we have to take over the management of these companies and get them to be publicly traded. And then everybody's going to be able to participate, and we're going to run them in a scientific way that's going to be for the betterment of everybody. a big part of that too is, yeah, again, that violinist argument of they did not want to actually have to figure out how to solve real problems or do real things. They want the freedom to just sit around all day thinking big thoughts and get paid for it. Um, I think this is also the concern of Uncle Ted in most of his literature is it's like the Borg. It's this assimilation system. It's that you end up serving it instead of it serving you. And I mean, that we might go down that path for a while. I don't think it's sustainable in the same way that, trying to look at the stock market as if it's some, that it can be predicted, or, oh, we'll just pre-calculate what the value should be, or we can, that we can automate these things. Even the big AI craze now, and, I have friends who are involved in some very interesting AI projects, and there's a lot that it can do. But even like using ChatGPT, everybody is so wowed by it. And the biggest takeaway I have from it is all it is doing is in a natural voice summarizing things that other people have written. So there's no new information there. It's like trying to recall a memory and try to get something new out of it. There's no new information there. You've already heard it before. And especially as that kind of AI presents this illusion of increased productivity, or now suddenly everybody's an expert. They're not an expert. They're just regurgitating what ChatGPT tells them, and ChatGPT just tells them the things that other people have already written and
Yeah.
thought about.
And I've seen this a few times. I have a few friends who've like set up their own bots that have some deviation of ChatGPT, or maybe a bit more acutely designed. And it is just a glorified search engine. And you can tell that when you give it a very specific question and it says, well, it's complicated, and just barfs out a bunch of hemming and hawing about an issue. Like it'll give you ask it about Kissinger. You'll just get the Wikipedia entry on Kissinger.
Right. So, I think there's a valid point to the Butlerian jihad of, as soon as you have the machines doing the thinking for you, the humans will stop doing the thinking. But they can't really think. There's something missing there. And again, it's going to be another form of this stagnation, that you're not getting any real growth or innovation. Going back to some of these generational dynamics with younger people, people have grown up in the wake of the 2008 Great Financial Crisis. I noticed there's a huge emphasis on marketing and social media and sales funnels based on newsletters and Instagram ads and what have you. But if I try to talk to any of those people, or almost all of them, about building a better mousetrap, innovating a better solution, they'll look at you like you have two heads. They're like, well, if that were possible, someone would have done it already. Like the idea that, oh, maybe you're the inventor that invents flubber or something is alien to them. They just cannot imagine. And then Mark Fisher and Nick Land on the left get into this. They identify that same phenomenon as the slow cancellation of the future. It's this weird dead end of postmodernity of we're all just marketing and entertaining to each other, but the idea of that you could actually make something, invent something, do something new, or in the film industry, right? Everything's a remake of a remake of a remake. I think they're making a third Willy Wonka movie.
Well, what's interesting there, to tie into the larger point you were making, is the phenomena of Disney, and Disney almost as some simulacra of the stock market, is that people are in love with the size of Disney. Disney produces actual fucking garbage. But if you ask a Disney fan, like, they're just in love with the fact that the Disney is such a big global corporation and that they are a citizen of it. And they're just in awe of this entity, regardless of the fact that it produces worse and worse products.
I've encountered this culturally as well, which I think is also fascinating. I've kind of had to bump into it. But yeah, especially with the younger generations, if it's not some mega company producing something, it's like they don't think it's real. It's almost like they are the first generation cognitively prepared for accepting a world where small business no longer exists.
And you actually kind of saw this with boomers, and I made a comment on the show before that boomers were the first generation, and I still see this, where they believe literally everything they see on TV, to the point where if it's not on TV, it's not trustworthy. Like they'll ask you and that means that they would fall for whatever was on TV way more easily. And that was just a distinct thing. We haven't really evolved past that. We've just kind of changed what the medium is. But with this, it's like, oh, it's big, it's culturally relevant. And one thing we talk about on the show, and you might find this because you seem literate in this sort of media literacy. A lot of this is discussed by marketers,
Mhm.
actually.
Right.
But it's this idea that people are in love with the story around a movie. Like they go into a movie knowing that the actors went through a contract negotiation. Like for example, Fast and Furious. People go in to see the new Fast and Furious movie knowing that there's a feud between Vin Diesel and The Rock in real life, and they're hoping that a contract negotiation is visualized on screen in front of them. There is no magic to the movie. The story of how the movie is made is part of the movie itself, and what you are watching, like people will get excited when they hear that a new like Disney is going to be making this new brand of comic book. Like they're excited about reading news about a board meeting that went well.
So
And
right. So
yeah.
this is like the commodification or something. Prude is right that there's this point where it's like, oh man, I sound like a Marxist myself. But a fan culture, right? At first, fan culture was exciting for these businesses of, oh, they're going to do the marketing for us, and they have fan clubs and they're going to build up this excitement, and we don't even have to pay them. That's great. And it went from, oh, this is a surprise bonus to this is now standard operating procedure
Yeah,
to
I got one for you. I know real people who use the term brand evangelist. How about that?
Mm-hmm. Well, that gets me in a whole that everyone since the rise of social media has just kind of nakedly accepted this idea of personal branding, and I get that yeah, you're going to have to sell yourself in the sense that persuasion is part of human interaction, but that kind of split personality, it's very like the movie Perfect Blue or something. It's very schizophrenic between that now you have this front facing persona that you're inventing as opposed to uh, like what's her name who's Hannah Montana or something. Like at what is there the real person there, or this is just a construction?
Yeah.
That's
Your entire mind becomes bifurcated the moment you make a LinkedIn profile.
mhm.
Like LinkedIn is the most miserable place a person can be, except for you. You seem to have a cool one. I had to leave LinkedIn because I started fucking with people, and that was like that's a hostile place for people who just wanted to fuck around.
Oh, so yeah. I mean, as an aside, LinkedIn is where all the real schizo posts happen. It's amazing how it went from, oh, this is going to be a digital copy of my CV because I forget what years I worked from here to here, to then they tried to make it more like a Facebook competitor. They wanted to encourage social interaction. Well, as soon as you start encouraging social interaction, people can't help themselves and the real thoughts start coming out. And so now on this business professional network, yeah, you get the same kind of polemical output as you and marketing to go with it as you would anywhere else. And in some sense, I'm fine with that too. I mean, if that leads to, peaceful national divorce and pillarization, kind of like New Founding or these other companies are trying to do of, hey, we're just not going to agree. So let's at least identify who we are and split up instead of trying to be undercover and appease everybody. If that's an accelerant to that process, then good. I'm glad it's there.
Now, before we go, I know I wanted you to talk about how you can help people out professionally. I know you're working on a book on this topic, and I believe, like you said, you run a business where you handle things like this. If you wanted to talk about those briefly as well.
Sure. So, book as soon as I get it out the door is about how the invention of publicly traded securities is the financial bootstrapping of the managerial revolution. So, integrates a lot of those criticisms that are very common about central banking and income tax, and pulls in that missing piece of, oh, how come big business acts exactly the way that the government wants to during a lockdown and all the small businesses are the ones fighting it? Like that's the battle lines there. So a lot of detail, the history and how that manifests and kind of the consequences of that. And thank you for saying so earlier. What that means is, as this publicly traded system that everyone's kind of become over dependent on grinds to a halt, well, especially anybody who's had some success in their life and they've reached a point that they're going to make an exit of hopefully a few $1 million. Let's say the minimum, according to the government regulation, is $1 million in investable assets to meet the accredited investor criteria. That's where I can really start to help people who are the successful entrepreneurs looking to sell off their business. They'd want to avoid having to pay capital gains tax, which will probably eat between 20 and 40% of that sale price otherwise. Most M&A firms do not know how to do that. This is another one of those examples of there's a better mousetrap out there and just people don't know about it. So don't assume, oh, whoever I'm working with probably knows all the tricks of the trade. They don't. Feel free to reach out to me. And getting them into a way to defend their purchasing power, regardless of what might come in the future. My firm also deals, so that's kind of the cornerstone or the bread and butter of what our practice does. This also works for real estate, especially commercial real estate. It can work for people who want to diversify a crypto position. Any highly appreciated, significant asset we can work with. But where that then dovetails with this content is looking beyond these publicly traded securities into other asset classes that actually provide real defensive positions against whatever may come, that they're not tied to the market cycle the way that the traditional 60-40 index would.
First of all, I have to get going right now, but I think we covered everything I wanted to cover. And I just wanted to thank you very, very dearly for taking the time to sit down with me today. I found this all very, very fascinating. I think I'd like to have you back because we touched on a lot of topics that we could probably spend quite a bit more time on. And as we delve deeper in the upcoming episodes into the more financial side of things and interesting new ways of handling money and capital flows, we might have some more to talk about and to expand upon.
Yeah, I'd be happy to. This was a wonderful conversation. Thanks for having me.
All right. Thank you very much. Have a good day.
Yep, you too.
Do not let the rapists win. Listen and love Blood Satellite.